Okay, Jim Hendrickson, I'm going to chair the meeting tonight. I'd like to call to order the meeting of the City of Norwalk Pension Board. Do we have any members of the public in attendance by video that would like to make a comment? No, it's not. Let's go to approval of the minutes from the December meeting. Does anyone have any comments on them?
Good to me.
If not, we have a motion to accept.
Second.
So Mr. Baskin, motion to accept, Mr. Kramer seconded, motion all in favor,
Aye.
motion passed. We have no pension applications for today. So I think we're gonna have Callan review the 2024 activity and a look at 2025 plans for work next year, this year.
Great, thanks, Jim. So as we do each year, just want to summarize all the work that the pension board has done over the last year and plan the future presentations and projects for 2025. So here you can see, in addition to performance, we did asset allocation studies for both the pension and the OPEB. We reviewed and updated the pension IPS. The OPEB investment policy statement will be reviewed in 2025. We did fee analysis for all plans, including the DC plans, and had a number of portfolio reviews, including the actuary, who will continue to present annually to the board. On the next slide, in terms of the work plan, I think in terms of priorities, coming off of 2024, where we've reviewed the asset allocation for both the OPEB and the pension, we think it's prudent to have the fixed income managers come and present. ABS, it's been 2 years since Blackstone was terminated. I believe, in terms of a global equity long short allocation, ABS has done very well for the plan over the intermediate and long-term periods, but will be good to have them in, hear what they're seeing in the markets and the opportunities they're seeing, as well as PIMCO All Asset. One presentation that doesn't typically happen on a more frequent occurrence is the Custodian Northern Trust. I think it's been about 3 to 5 years since they've been in, so it'd be good for them to come in and provide an overview of the services they're doing for the pension and OPEB plans. Tonight we have Capital Group presenting a review of the target date funds. And I think the next DC meeting is in April, and we were going to have Empower and present.
What would a Northern Trust presentation look like? What do they cover?
The services that they provide, the fees, can talk about SEC lending, and just review the relationship that they have with the two plans. I think, there's no issues from Callan's standpoint. They're institutional custodian. I think, Chitsme, you work with them on a much more frequent basis than we do. But it's just for fiduciary best practices on a reasonably regular occurrence to have them in. One, the city's receiving everything they need from them, and the board understands what they're doing behind the scenes.
Are there any metrics that custodians are tracked by?
We have a team at Callan. We can ask, we do custodial searches and reviews for clients, and one thing that we might be able to bring is more of a fee benchmarking type analysis.
Service metrics of any sort?
Yeah, I'd have to double check,
Yeah, okay.
but we can see, I think for the most part, I don't know if Chitsme can speak to her experience with them, but I haven't seen any issues in terms of the services they're providing, or the trades being placed and the custody of the assets. But
Yeah, I mean, they're pretty available whenever we need them, if we need to do certain transactions, I know, they'll meet with us on a monthly basis. We timely get the report as needed, logging into even their web portal. It's pretty user-friendly on our end. Trying to get certain report for our financial purposes, so yeah, we don't have any issue with them.
Have we had Walter Scott talk here presented? Have they been around long enough to?
Yeah, they have. I mean, I think one of the things you'll see in performance is their style has been out of favor, and that's whether it's Norwalk's international strategy or their global equity strategies or across their platform, just, their quality focus and growth at a reasonable price approach is not done particularly well.
Yeah.
But yes, we can add them to the list, certainly. I think they've been in the plan 2 years, probably.
Yeah.
About 2.5 years.
I would think that in the second half of the year, depending on how they do, Principal Smith, you should have one in too.
Yeah, I think we've had them in annually in the fall, but unless something concerning comes up before then, we'll plan for that. Okay.
And everyone else is sort of performing in line with the parameters.
Yeah. No, I think largely the managers have done very well. The BlackRock Emerging Market Fund that we had in recently has struggled. I think one of the reasons behind that is China and such a big part of the emerging markets index, and it's hard to determine what news is coming out of China and whether it's good or bad, but the markets are reacting, and I think they've gotten caught on the bad side a couple times, but
Their data.
in terms of, concerns, watch list, I think Principal, just given their performance, it has improved a bit this year, but other than them, I think we're pretty comfortable largely with.
Yeah, I think Frank got things started, but it empowers contracts up this year for the.
It automatically renews.
Yeah.
So I assume that is,
I know he reached out.
I think it's
to
up in
procurement department.
February.
Okay,
We can, did you ever touch base with Brendan and Empower?
Frank's done something on this, I
Okay.
think, so,
Okay,
or maybe I'm thinking about your contract.
No, it was
Are
empowered.
you guys up
No.
this year?
Just a year and a half ago.
It's Empower was up this year,
Yeah.
Yeah,
Correct.
Frank's on it, I think, okay,
And I think our actuary. The contract that was up.
yeah.
Yep.
Okay.
anything else that the board would like us to add or prioritize in terms of 2025?
Looks good. Rich, anything?
All right.
Okay. No, I think we're good.
Great.
Thank you.
And in terms of next month, I think we only have a pension meeting, so it's probably a good time to have a manager present. Would one of the fixed income managers be reasonable?
Yeah.
Well, as long as Frank's here.
Either one, doesn't matter. What do you guys think?
I think TCW. They presented not last year, the end of 2023. I think their performance has been, it's improved more recently. They had a duration bet in 2022 and 2023 that did not work out very well for them. They've had some team turnover. It would be good to hear an update from them.
Okay. Anything else? We go to performance.
So tab 1, if you're on the hard copy, just a quick backdrop, we have the flash report as of November 30th. You recall in November, election month. So given the results, equities and fixed income were up despite mixed economic data, seeing a slowdown in job growth that led the Fed to actually cut rates for the second time by 25 basis points. US outperformed non-US. We saw large cap and growth stocks continue to come back into favor. outperforming small caps and value stocks. We turn to page 3 of the PDF, just showing the asset distribution. Total assets about 551.2 million. I would note US equity at just over 40% is just barely breaching the upper range of the US equity target. The board did redeem 9 million from the Russell 1000 index in December, so that should bring it down back within IPS parameters. You'll also see a distribution from Pantheon Private Equity of 217,500 in November. Fund 7 is making a $50,000 distribution in January. So we continue to see distributions as these private equity funds wind down. On the next slide, we show fiscal year and longer dated performance. By and large, fiscal year returns have been very strong. Total fund is up 6.7%, well ahead of its custom benchmark. In terms of your active managers, LSV has underperformed a bit. Longer term continues to be strong performance. Their deeper value style has not been rewarded. In principle, you can see largely in line with the benchmark and up over the trailing year, which is encouraging to see. And you can see over the 5 and 7 year periods, very strong performance. One note with LSV, I think we discussed the employee lawsuit
Yeah, that's
at the previous meeting. We haven't received any updates. We'll continue to monitor that and keep the board updated on that as it develops. Silchester, positive performance, slightly underperformed the value benchmark. Longer term continues to be a strong manager. Walter Scott, who we'll have in, as I mentioned, has really struggled since entered the plan about 2 years ago. From a Callan perspective, we have conviction in Walter Scott. They're stick to their philosophy, and there are certain times when that philosophy is out of favor, but we'll hear from them at a future meeting. BlackRock Emerging Markets.
Walter Scott's we only had really 1 year or?
Well, it's about 2, but it hasn't been 3 yet. So that's why.
That's why this
It's
is
fine.
dot there.
Yep. BlackRock underperformed largely due to an overweight to China. Given the election results, a lot of uncertainty internationally, especially in China with potential tariffs. And then you can see ABS, really strong performance fiscal year to date and over the trailing year. Longer term, they continue to outperform their HFRI benchmark and continue to be a nice diversified source of return for the plan. On the next page, fixed income managers have both outperformed fiscal year to date. TCW Met West, you can see over the 3 year period, trails. Longer term has outperformed, but given their core plus focus, we would expect better returns net of fees, to be honest. I think they have tended to take less risk in terms of the sectors they're going into, and the duration bet that I mentioned earlier has hurt them over the trailing 3 year period. And then finally, UBS, so your absolute return manager, they're really seeking to provide a positive return regardless of the market environment, and they've done a really nice job, both the near terms and over longer terms. And PIMCO All Asset Fund, who's one that we should probably have in 2025. Been a few years, but this is a real assets option that includes a broad basket of equities, credit, and diversifiers within commodities. But they've done a nice job, and you can see over the trailing year, really strong absolute return, and over the 5 and 7 year periods, returns well over the discount rate.
And good.
Any questions?
You're good with that? Voted up last month. Okay. Okay, nothing else for the pension board, so with the defined contribution, we have a motion to adjourn the regular pension board.
Most to adjourn?
Mr. Kramer, no motion to adjourn, second.
Mr. Baskin seconds.
All right. All in favor?
Aye.
You are adjourned. Call to order the meeting of the city of Norwalk defined contribution plan. I guess we have having capital group in first, right?
Can you go grab them?
Yep.
Sure.
Yeah.
There's two of them.
Yeah, there too, yeah.
There's one more chair maybe.
I can move over here too. Sure.
Do you need to approve the DC minutes?
Oh, yeah, we do. Yeah. Thank you. Has everyone had a chance to review the defined contribution meeting minutes from October?
Yes,
Motion to approve. Sebastian,
I move so. I so move.
you have a second? Really? For all your seconds, all in favor? Aye. Aye. Good. Whoa. Wow, guys.
Yeah.
Thank you for coming out in this weather.
Yeah, absolutely. It's impressed.
Wear coats.
You know what? We left it in the car.
I had the heater on blast, so it's fine.
They're real men.
Got some good copies here.
I got it. I got it.
Good to see some familiar faces.
Frank Nash is our chairman. He's out with the flu tonight.
Oh, no.
God.
We'll live without him for a little bit.
That's why I send my regard.
Yeah.
I think we have 20, 30 minutes is fine. I think we know the organization reasonably well, so if you want to dive in, I get most interested in the performance, but if there's other political stuff you want to cover, that's fine.
Yeah, of course. Well, first of all, thank you so much for having us here today. I really appreciate the time. My name is Evan McCloskey. I haven't met any of you yet, but I'm a relationship manager here at Capital Group, focused specifically on our relationship with the city of Norwalk, Connecticut. I can send you my contact information after this, but I'll be your main point of contact if you ever need something. So please never hesitate to reach out if I can ever be helpful with anything. Joining me here today, who you might remember is Jeb Benton. He is our multi-asset investment director focused on our target date suite of strategies. So I'm excited to have him here today as he can answer any and all of your questions about the strategy. Before I go any farther, I just want to thank you all for the partnership that we've had with you guys. Next month, we'll be celebrating our 5-year anniversary of working together, having funded back in early 2020. So really just appreciate your support and confidence over that time and really looking forward to working with you all going forward.
Well, as you know, we're kind of the relative still beginning of the defined contribution program, so it'll be growing.
That's great to hear. We'll take it. So as you mentioned, I think we do 25, 30 minutes, so we'll stick to that. And like you said, maybe if it's helpful, we can start with just a quick refresher on the strategy objective,
Yeah.
team process, and then spend lots of time on the glide path. That being said, please jump in with any questions and direct us to whoever might be most helpful. These are always more fun, the more interactive they are. If it's at all helpful, I can just give you just a quick reminder on the organization,
Sure.
maybe just a quick minute for those who might not be as familiar with us. Here at Capital Group, we're one of the world's largest privately held global asset managers with a history that goes back to the 1930s. We're celebrating a 100-year anniversary in 2031, so we're really excited about that. Currently, we have the privilege of managing about $2.8 trillion in assets for clients around the world. Out of that, about 340 billion of that are in our target date suite of strategies, which makes us one of the world's largest active target date providers. I think one of the things that differentiates us, and I think one of the benefits we have is our privately held partnership. This gives us a number of benefits. One being that it allows us to take a really long-term view, how we manage the business, our investment decision-making, how we approach investments. So really align our interests with those of your clients, such as yourselves. Another benefit of the private partnership is that ownership is broadly dispersed across the organization. And this results in extremely low turnover, especially on our investment staff. So one of the lowest in the industry. We have people who are managing some of your portfolios who've been with us for 10, 20, 30 plus years. So it just gives us incredible kind of continuity experience that you don't see kind of broadly in the industry. So, I think the main takeaway is that we remain incredibly stable and focused on delivering for clients, such as yourself, and more importantly, your underlying constituents. So maybe I'll stop there. Happy to answer any questions about the firm, but if not, I can turn it over to Jim to get into the portfolio.
Sure.
Awesome.
I guess I'll start with the punchline because you referenced results. So 2024 was another really strong year. These books are as of the end of the third quarter. We have the fourth quarter numbers as well. I will tell you, our average percentile rank amongst all target date peers is in the 13th percentile over the course of the calendar year. And I'll get into the market and how we were able to generate those returns. But most importantly, even as you think about the 5 years that we've been fortunate enough to manage on behalf of your participants, over that 5-year period, when you look at our peer result ranks, the average is in the 6th percentile. So we continue to be very strong relative to our peers in the industry, but that's returns, and that's part of the experience of your individual participants. The other part of it is the volatility. Over the last 5 years, we've experienced quite a bit, especially in the first quarter of 2020. When you take a look at our total risk ranks, which is defined by standard deviation in that same 5-year period, we fall in the 17th percentile. This is utilizing Morningstar's database. So we've been able to generate top decile returns with a fairly moderate to really conservative risk profile. And when you put them all together, that leads to industry-leading risk-adjusted return. So again, taking a look at that 5-year number, we're in the 4th percentile of risk-adjusted returns, according to Sharpe. So I wanted to start just upfront in terms of where we are, and then now I'll kind of backtrack.
What was the previous 10 years?
The previous 10 years?
Yeah.
2nd percentile from a returns perspective. 16th percentile standard deviation, and there's literally all ones in the column for the 10-year risk-adjusted basis. So we've been able to generate very strong returns. Yes.
Is that aggregating across all your funds, or how do you put that number together?
So we put that number together just looking at our metrics, so return metrics, standard deviation metrics, and risk-adjusted metrics versus the entire category. So that category in the 2065 fund will be comprised of other 2065 funds of competing peers.
Is it a weighted average basically though?
No, it's just a pure dispersion and
Yeah.
kind of where do you land amongst the individual quartiles and percentiles relative to the peers in the group.
Active and passive.
Active and passive, yes, active, passive.
And the results are similar to Cal's peer group in our vintages, the Sharpe and the returns over intermediate and longer term periods are very strong.
If I were to take you to page 12, this reminds you of our objective and our unique design principles. As Adam alluded to before, again, we're fortunate enough to be one of the largest target date managers across the globe with north of $340 billion in assets. Our strategy is driven by this dual objective of building wealth and preserving wealth. And that's a really delicate balance because we know your participants, they do want to grow their wealth, right? They want strong growth in their account balances, but also when the going gets tough in terms of market volatility, they want to be sure that they mitigate some of the volatility, especially those folks that are approaching retirement or in retirement. And we do this uniquely different relative to some of our peers. So you'll see on the bottom half of the page our 4 design principles. The first one is our glide path within a glide path approach. So when you think of a glide path, of course, that 25 and 30-year-old, we're going to allocate more equities to that strategy or to that individual vintage because those individuals have high human capital, but low financial capital, and they need growth in their portfolios. As we get closer to retirement, as you'd expect, we're also going to lower the amount of equities as you age and you build your financial capital. We need to be a lot more focused on risk. So that isn't very different from the industry. What is different is that In the accumulation phase, as a 25-year-old, we strongly believe that you should own, growthier equities. You should own the Metas of the world, within the Teslas and the Nvidias, because those are companies that have strong earnings growth and higher PEs, and they're volatile, but they have time to stomach that volatility. But when I think of someone like my mother as a 70-year-old, although I don't think she'll ever retire, we believe that not only should those individuals own a lower level of equities, but they should own different types of equities. So the largest equity holding shouldn't be the Max Sevens, but they should be companies that have a strong history of paying dividends and growing dividends. And historically, those companies have been able to mitigate volatility. So back in, I think of some of the volatility that we experienced, back in calendar year 2022, back in even a third and fourth quarter of 2023, those nearer dated vintages stood quite well in those turbulent markets because of our more dividend oriented focus. Bottom up flexibility. This is important because we are utilizing the strength of our underlying strategies to make relative value decisions. So our top down 8-person team, which I'll introduce you to here in a moment, they do make a strategic asset allocation. But on a day-to-day basis, our underlying managers, where we have, again, a 90-year track record of generating strong returns, they'll be making some of those relative value calls between US companies or non-US companies or stocks and bonds. And then our underlying strategies. As an active manager, we are using some of our best and most proven strategies with a very long track record, and they have a history of generating alpha and doing it with lower volatility. And then lastly, we did build a glide path to support withdrawals 30 years through retirement. So I wanted to spend a little bit more time upfront on the objectives as a reminder, because our investment process is what drives results, and we will continue to keep that process consistent.
Thinking about those things, like with respect to performance, then, so active management is really tough, particularly in the US side, large cap, even more particularly. So what's been driving the outperformance then for you all versus like a passive target date fund manager? Is it more allocation decision to say we're gonna be tilted growth versus value? Like, where's that coming from? Where's that alpha coming from?
Yes, I would answer that a couple of ways. So I would say broadly, when you think of glide path construction and asset allocation, those are active decisions, but they may be utilizing underlying passive strategies, as you know. So I would say every decision is fairly kind of active from an asset allocation perspective. Now, the utilization of the underlying strategies, when you take a look at our attribution, security selection is about 50% of the alpha generation. About 20-ish, 25% is the strategic allocation. That's our long-term allocation to US equities, non-US equities, and bonds. And the remaining kind of 30 to 35% is that tactical bottom-up flexibility I discussed. But to answer your question broadly relative to our peers, a couple of things. When you look at our accumulation vintages, we have more of a high growth factor exposure, and growth has done well. So when you take a look at our strategy relative to other managers, many of the other managers have higher equity exposure than we have, but stock selection has been fairly strong, and we just largely have a higher growth factor exposure. So more exposure to an asset class or a style that has been in favor. Also, when you get closer to retirement, and you'll see really for the better part of the last 7 years, our geographically flexible portfolios have been investing more in US-based companies. So when you look at our exposure to US domiciled companies relative to our peers, on average, it tends to be a bit higher. And as we all know, the US market has outperformed non-US markets pretty considerably. And then the last part I would point to, and this really impacts kind of the Sharpe ratios and the risk measures in those near retirement vintages. Not only do we have a higher allocation to US-based companies, and that's part of our strategic design, that dividend orientation, especially in those volatile markets, even though dividend payers have underperformed growth, has been hugely beneficial, because if we can help minimize those down periods and mitigate those valleys, it gives participants a head start when markets recover.
So really quickly, page 13, Michelle Black,
My good friend and our team, she continues to be the leader of our Target Date Solutions group. Michelle was once again recognized by Morningstar as one of the top portfolio managers in asset allocation and recently recognized by Pension and Investments as one of the most influential women in investing. When you take a look at the entire team, it's rounded out by three other solutions portfolio managers, Samir, Raj, and Wesley, and fixed income portfolio managers, David and Shannon, and equity portfolio managers, Will and Jessica. And what that allows us to do is get our most experienced portfolio managers with a diverse set of backgrounds to be sure that we get some of the best ideas into our targeting strategy.
If you look at the layers of decision making, you know, with high level asset allocation all the way down to security picking, what does this group do?
They do the high level asset allocation.
By
So,
country, by growth value, all those dimensions?
well, not by country, but we do it through traditional asset classes. So US equities, non-US equities, bonds, EM, high yield, but then also the selection of the underlying strategies. So when you think of, and I'll cover it here shortly, when you look at the breakdown of the underlying components that make up the target date, they set that. But at the underlying fund level, if you're in a global equity strategy, they may make relative value decisions between, you know, an Airbus or a Boeing or a Taiwan Semiconductor and an Intel. And we want to preserve that flexibility where the top-down function is really to help establish some of those kind of guardrails around
And this
it.
group's looking across all the target date.
Absolutely, every single one.
Okay.
Page 14 really shows that differentiation relative to our peers, and I won't cover each slide and start skipping some pages here. But if you look at the left-hand side, the shades of blue really highlights our equity exposure. So in that accumulation phase, you can see a pretty meaningful slug of growth equities that's going to be in the strategies that have, again, higher beta names, lower dividend paying names, but some of the growthier allocation. But as you get closer to retirement, as you can see, not only are we lowering the level of shaded areas of blue, so lowering the level of equities, but we're meaningfully reducing and then completely eliminating our dedicated growth equity strategies. And the vast majority of your equities are going to be in this growth and income and equity income bucket, which are strategies that are defined by companies that, again, pay dividends and have historically been less volatile.
So it goes from 80%, 80+% down to, I guess, 40% or so.
So if you take a look at the turquoise colored balanced, that's our multi-asset strategy that invests in both equities and fixed income. So at the start of the glide path, we're right around kind of call it 87-ish percent, 86%. And then we work our way all the way through retirement where we're getting, you know, closer, well, 30 years to retirement, I think we land right around kind of 27, 28%.
And in terms of fixed income implementation, are you utilizing longer duration at the beginning of the glide path, or is it mainly core fixed income throughout?
Yeah, so when you take a look at our fixed income, largely we want to use more conservative fixed income across the glide path. So fixed income can do a couple of things for you. As you increase your fixed income exposure broadly, you can reduce your market risk relative to equities. What you're seeing here on slide number 14 in that dark shade of green is essentially an allocation to treasuries and mortgages because historically outside of 2022 have had low correlation to equities. So even in the beginning stages of the glide path, we want to help dampen that volatility. As you get closer to retirement, 15 years before retirement, we introduce TIPS exposure, which are really intermediate TIPS, where it's there to hedge against unexpected inflationary shocks. Then we introduce more kind of core fixed income and right at retirement and 10 years past retirement, a dedicated allocation to high yield because those are your highest spending years as retirees. And then we ultimately eliminate dedicated high yield and start to invest in even more conservative fixed income. So I talked about mitigating market risk by increasing the level of fixed income, but not only is it more core bonds, we're actually shortening duration the deeper you get into retirement as well. So you're mitigating its market risk and interest rate risk as well. So part of those risk statistics and Sharpe ratio rankings are in years like calendar year 2022, where not only were we conservatively positioned within equities utilizing dividend payers, but we were shorter in duration that helped us against many of our peers who are much longer from a duration perspective. So fast forwarding to slide number 17, because I just want to be cognizant of the time, we're going to skip a few slides. This is the makeup of the asset allocation. These are the underlying strategies that we're utilizing. So I referenced the term that glide path within a glide path, again, lowering the amount of equities and changing the types of equities. If you focus in on the top half of the page in dark blue, that's our growth allocation. You can see a pretty meaningful exposure in the accumulation column. But as you get closer to retirement and into the distribution phase, we completely eliminate that dedicated growth allocation. And the vast majority of your equities are going to be in those growth and equity income buckets, again, that are defined by more conservative equities. Similarly, within fixed income, I kind of walked you through it here, but visually you can see the underlying strategies. As you get deeper into retirement in a way that you would read this, the most volatile strategies are at the top of the page. The most conservative strategies are at the bottom of the page. So if you look at the bottom two rows, those are our two most conservative fixed income strategies, and so happen to be the largest allocations the deeper you get into retirement. Again, to mitigate against market risk, but also to mitigate against interest rate risk as well.
When you look at performance, does the targeted funds at certain areas outperform more significantly and contribute more to your performance in other areas? Like the earlier ones or later ones, where are you really kind of achieving your contribution of excess performance?
I would say it's across the board. So when we take a look at the accumulation phase relative to our peers, we'll have a higher growth factor exposure. Growth is done well. Within fixed income, as we get closer to retirement, if you take a look, especially at our 5-year number, calendar year 2020 was really, really good for us because we were conservatively positioned in treasuries. So when the market sold off during the pandemic, we were actually able to sell to the market our, treasuries that were selling at a premium, and we were able to invest in other fixed income securities that were trading at a discount as spreads widen. So it's actually a combination. We try to add, again, my comment up front, about 50% of our alpha generation is through security selection, but then also having more of a tilt towards US-based companies have been beneficial over the last 5 years and 10 years as well. So looking at page 18, that just gives you kind of a visual representation of our glide path through the traditional asset allocation lens, and page 19 shows you those numbers through kind of more of a nominal table. Let's go to page 20, then I'll dive into results. But page 20 looks at that flexibility, which is a key part of our design feature. So this shows you our allocation to equities on the top left, allocation to non-US equities on the top right, our allocation to growth style equities on the bottom left, and our allocation to small caps and mid caps. I'll focus my attention on the top right-hand side. So this is our allocation to non-US equities. You can see with the vast majority of the glide path, our current allocation in green is lower than our average allocation in blue. So we've been investing really for the better part of the last 7 years. We've been investing in more US-based companies. I would say over the last 3 or 4 quarters, we've actually come off of the bottoms of that range where we've been finding some idiosyncratic opportunities outside of the US where we can add value. Now let's go to market returns. And again, apologies for this being third quarter, but I can speak to the full calendar year. When you take a look at the 1-year returns for, page 23, sorry, 23. Yep. So again, these are 3Q numbers. I'm going to reference 1Q numbers. So if you take a look at the 1-year number for the S&P 500, it was a fairly strong year. The S&P 500 up 25%. The international markets, the MSCI ex-US index was up 5.5%, and the ag was up 1.25%. So when you take a look at the returns across all of our vintages, our 2065 portfolio returned 15.64%, and our 2010 portfolio returned 8.1%. which for anyone that's, 10 or 15 years into retirement, I would gauge 8% is quite a bit. So we feel really good about those returns. And again, as a reminder, I said that average percentile ranking is in the 13th percentile, but this was also in the face of an environment where it was dominated by the Magnificent Seven. And when you think of some of those nearer dated vintages, we were able to generate those stronger returns while not owning nearly as much of those Mag 7 companies of some of our peers. Because again, the closer you get to retirement, our primary success metric is not returns, but it's really mitigating those drawdowns and volatility while being able to capture some of the upside of the marketplace. Similarly, within fixed income, clearly inflation has abated, but the rate environment continues to be one, at least from a recent historical perspective, is higher than we've seen before. So when you take a look at the 10-year part of the, when you take a look at the 10-year rate, right around 4%, we continue to have more of a steepener, which means that we're overweight the front end of the curve and underweight the intermediate point of the curve. Hasn't necessarily worked out exactly as we expected, but again, largely what holds true is that we're being more conservative in our fixed income the deeper we get into retirement. So page 27, I'll just cover 3 more pages, then I'll open it up to questions. Page 27, I remember last time when I was here, it's one of the pages that really resonates with plan sponsors, because when you receive calls from participants, it's usually not when the market is up 20 or 25%. It's usually when the market is not doing as well. So on slide 27, over our 17-year history, this highlights the 10% or greater declines. But for our purposes, if you take a look at really the last 3 columns, starting in 2020, you can see those are the down periods that your participants have experienced. And you can see largely kind of top quartile returns in those down periods. And our average down market rank across our nearly 18-year history is in the 18th percentile. So when you put together strong returns and a strong ability to protect on the downside, if you go to page 28, I think no page better captures our ability to capture the upside or build wealth and not capture as much of the downside or preserve wealth. So we continue to be one of the only target date managers that can really take a look at this up capture and down capture ratios, where nearly every single one of our vintages here exceed 100 on the upside. And every single one of our vintages on here, again, this is looking at a 10-year lens, does not exceed 100 on the downside. So the quick math of it, you start with $100, you lose 20%, you're at $80. To get back to $100, you need 25%, not 20%. So again, as my comment earlier, if you can help mitigate those valleys, you give your plan participants a head start when markets recover. And then slide 29, again, this is through the 3rd quarter, but I referenced the returns through year end to start this. So let me pause there to see if there are any questions.
What, your interaction with Empower? I mean, obviously you're getting the data from them with the asset values and so on, the investments. Is there any participant value going back and forth, or what if any detail do you get other than the dollars in each fund? Is that it pretty much?
Yeah, so the data coming from Empower is kind of proprietary to you all in Callan. We have a great relationship with Empower, but your data is your data unless you give us access to it.
Yeah, and Jim, just so when we did the record keeper search and the new structures and the new lineups were rolled out 5 years ago, because before we didn't have assets that were necessarily going to be put to work, all of the funds are mutual funds.
Mhm.
So plans are invested in Capital Group target date fund mutual funds. So from their perspective, they don't see it necessarily as the city of Norwalk participants, but because we work with Cap Group on a number of clients and, can share the transparency of where the plan started, where they're going, we're able to give that. But Empower, is really in charge of tracking participant assets, making new investments based on where they want to allocate their funds, and
Yeah.
allocating mutual
The
funds.
reason I asked, because there were a couple of slides up front where you're talking about participant engagement, which got me, I didn't know, was there any, what role, if any, do you have in that? None really, right?
Well, we supply quite a bit of marketing literature
Okay,
to
yes, right.
Empower.
But it empowers the front end for all that.
I believe so, right?
Yeah,
Because I
yeah,
think on
okay.
Empower's website, because we provide them with
Yeah.
fact sheets and a
Yeah.
variety of different kind of
Okay.
marketing materials, but if there's anything that you need
No, no.
outside of what
Yeah.
Empower can deliver, we can absolutely get that in your hands and Callan's hands.
This downside risk management, is interesting. It probably is most sensitive to those, the actual, participants. I mean, how they react when downturn markets and things like that versus,
Yeah.
and I guess my question was, and I wasn't sure whether you see it or Chisby sees it or Empower sees it. How are our constituents when they see the downside, occurring? Are they giving us positive signs that they feel like we're managing the risk well and that this is the right way of going?
Empower's
Or
gonna see that.
Empower's gonna see that?
Yeah,
Contribution.
inertia is,
Yeah.
is very large in DC plans, so.
Yeah. Yeah, I would tell you broadly, when we put together our demographics, so we have 1.5 million individuals on our own proprietary record keeping services. We comb eBreeze data as well, and there is quite a bit of inertia with participants, although you tend to receive those calls at the end of the quarter. So if there's intra-quarter volatility, no one knows, maybe at the end of that quarter, you may receive more calls, but what we've witnessed, not meaningful amounts of change in allocations, but a slight uptick in more volatile markets, but not.
People who are,
Massive.
yeah, with target date funds, they tend to just stick with the target date funds, which is exactly what we want.
Mhm.
What happens is those who use more of like the core menu, so that would be whether it's like an active, equity fund or the S&P 500 index fund, you'll start to see those amounts increase during go-go years, like the last decade. Usually they're late to the party too.
Yeah.
So, and the fixed income side, or like, when things are going the opposite way, all of a sudden the stable value or the fixed income allocations will pop. Which defeats the point because it's after the fact.
Yeah.
But that's what it's the
So,
emotional.
Do we see our participants at all, almost like downsizing, you can go into a longer, like a longer term, position, is during good
Vintage.
years, vintage, and
Kevin
vice
and I were
versa.
mentioning before
Shorten it,
the meeting.
No, we do that. We do
Same.
that because we're in the industry and we understand like that you can do that. Most people don't even realize they pick the one that's.
For
like,
them.
Hey, we're gonna retire in theory in this year, and they just
They pick that one.
set it and forget it, which is honestly a really good
We
thing.
want them to do.
And one of the
Yeah.
things you'll see in the structure analysis that we'll discuss after Capital Group is 401(a) plan, participants are defaulted into their age appropriate target date.
Yeah, makes sense.
And over 90% of participants are invested in one target date fund.
Makes sense
which
too,
is
right?
Exceptional.
Which we want.
Yes. And that has not changed much at all over the last 5 years.
So they're not overreacting, they're too much risk, therefore, let me shorten it,
Right.
or not enough risk, I want more growth, let me lengthen it. They're not doing that.
They're probably not looking at it, which is good, honestly.
Yeah.
Internally, I'm sorry, go ahead. Internally, where are you investing your funds in research, getting your process better? Where's your budget, your budget being spent internally to get better? I mean, it's, your market's very competitive, you always have to get better. What are you doing to get better?
Find alpha, no,
So
reduce risk.
so our mission as an organization is to improve lives through successful investing. And where we spend our capital is to indeed deliver on that mission. And oftentimes that's through our investment process. So our research, to give you an idea, we have north of 450 investment professionals that are all over the world. And they essentially don't have a budget in terms of being able to go and travel to see the individual CEOs and CFOs to make good investment decisions on behalf of our investors. Also, when you think of technology is clearly very important. We want to improve our technology tools to be sure that we're delivering, strong investment returns or really strong client service. So that is where we focus in our attention. We're doing a little bit more advertising than we did 13 years ago when I started, but our core focus is usually spending that next incremental dollar on being able to deliver better returns for our clients.
Do you have any kind of feedback loop on your investment process? What's working, what's not working? Pre-mortems, post-mortems, just, you know, how are you evaluating your decisions from a process point of view rather than just a return point of view?
Yes, I should have shared that maybe upfront. What's very unique about Capital is the way that we compensate our portfolio managers and analysts. So they are all compensated on 1 year, 3 year, 5 year, and 8 year investment results, where the bulk of their compensation comes from those longer term numbers. That 8 year number is going to be by far their biggest chunk of their investment returns. So if they've made good investment decisions that have outpaced the benchmark and peers, they will be compensated appropriately. If they have not exceeded those benchmarks, they won't be compensated as well as they would if they had done better for our investors. So we want to align our success with our investor success, and that's a critical part of how we think about, aligning our own incentives with our clients.
Is there a forced turnover rate for those that aren't performing as well? And I mean, if you're sticky employees, given your structure, but at some point, some people need to be let go.
Yeah. So I would say it's
what kind of a number is the percentage of that, of the 450?
I will say it's stickier with the individuals that have been here for quite some time because they've proven themselves. We don't always talk about the folks maybe that are earlier in the career that may not pan out. So absolutely. It is what is core to what we do. We are an investment manager and you all pay us to generate really strong returns.
Yep. Okay.
Page 17.
Yes.
How has this changed over time? And then what's your process for changing this? And how much is this contributing to your alpha versus actual, equity selection and instrument selection?
Sure. So it does change over time, and we have a slide for that, page 21. So if you go to page 21, you can see since inception, some of the allocation changes and additions that we've made to the portfolio, a kind of high level explanation as to why we made the research that has led to those changes. So that 8-person committee that I introduced you all to before, they're part of the research function, but we also have this 21-person multi-asset research team that are comprised of, PhDs and other quant analysts that are helping put all the pieces together. So they operate as the central nervous system. So there's this kind of iterative process between the 8-person committee and this core research team, where there are ideas and recommendations and this feedback loop. And ultimately, if the research points to making a change within the glide path, we will ultimately do that. But you can see that on slide 21, how frequently it's happened. And to answer your question in terms of alpha generation, I'll just remind you those 3 sources of alpha.
Yeah.
Security selection, about 50%.
Is that much?
Yep. 20%, 20 to 25% are strategic asset allocation, another like 30 to 35%. That's going to be in our flexibility bucket. So that more tactical shifts from the bottom.
Do either one of you have a sense, if you look at all the target date assets sourced out of the US?
Yeah.
What's the split between active and passive?
So that's a good question. There's about $4 trillion in TDFs. I know how much Vanguard has that at one point. Let me get back. I don't want to steer you the
It's
wrong way.
massively weighted to passive.
Yeah.
Like the top, I think you guys are the only active within the top 5 of the highest, like
Okay.
AUM.
Yeah, so we're number 5. So if 1 is Vanguard, they're fully passive. 2 is Fidelity that has some active, but their passive is probably doing a bit more. You all can speak to that. Number 3 is T. Rowe, which is a combination of active and blend.
Right.
Number 4 is BlackRock, which is passive, and then we're number 5 in terms of overall AUM. And I didn't talk.
You're 100% active?
100% active. We recently launched another strategy. That's a blend strategy. It's only been around for 7 months, but 99.9% of our
But all
assets.
the performance metrics you were citing before were
Fully
the whole universe.
The whole universe, entire universe.
Just one sort of minor question, on page 20,
Yes.
you have small and mid caps, you're ramping up the allocation after retirement. Does that indicate stability in those securities or what's driving that?
Yeah, so those levels are a tad bit, what I would say, as you get closer and deeper into retirement, they tend to be lower. What you're going to see in the equities that we own deeper into retirement, some of those smaller companies, they're paying dividends.
Mhm.
So if you look at our allocation to small caps, if you were to look at slide 19.
Kind of an income orientation.
Yep, there's an income orientation even to those kind of smaller capitalization companies. Also, what you're going to find outside of the US, there are smaller capitalized companies that are paying dividends. So if you take a look at the 3% or more dividend payers across the globe, about 75% of those companies are outside of the US. So you're going to get some more of those ideas kind of the deeper you get into retirement. And even as you take a look at, or let's go back to the flex slide, the non-US chart, you could see somewhat on the top right-hand side, how that international exposure starts to tick up as well.
Okay, John, fine.
The same page 20 on the top right-hand side.
The way right.
Yeah, the way right. So
Yep, yep.
non-US equities, you could see that number starting to increase because we're finding more opportunities for dividend payers outside the US relative to inside the US.
Good.
Interesting. Nice job.
Any other questions, anybody? Good. Thank you.
Thank you. Thanks for having us.
Yeah, thank you.
Thank you.
Yeah, absolutely. Thank you.
Yeah, have a safe trip.
Yeah, thanks for inviting us.
Thank you.
Or any follow-ups you on the finish, just let us know.
You're driving back somewhere now?
Yeah, I live in Manhattan, so
Okay.
I'll be driving down.
How about you?
Up to Boston.
Oh, okay, all right. You want snow on the way, so you're good.
Yes, exactly.
These are ass.
Yeah. Right. All right, thanks again.
Thank you, guys.
Good night. Going.
You seem pretty good.
Yeah, he did a good job.
Performance next, guys, on BC.
Well, what's the cost structure for their funds?
The average fee is 43 basis points, which
Moderately high,
not, I mean, not for a fully active
not for fully active. no,
strategy. I think Capital Group, the underlying funds, Capital Group is known to have extremely competitive fees for active management.
Yeah.
And that, sorry, 34 basis points,
Okay, yeah.
which is almost bottom quartile
Yeah, not ETF level, but
in target date funds. So, yeah, I mean, they're known as a very reasonably priced active management firm. And, you know,
delivering too, it seems like.
the target date funds have done great. I think one of the interesting parts they didn't discuss is they're the funds that make up the glide path. They have a very unique structure in which there's probably 6 to 10 PMs in each fund, and they each manage their own sleeve within that strategy, which is certainly unique. Yeah, they've done a great job, and you know, they manage a lot of money, which allows them to reduce their fees probably.
Were those performance rankings gross or net of fees? So they're probably adding 40 basis points versus.
They should be the mutual funds, so they should be net, and ours are net in our report as well.
It is net, cause I have exposure to them in the past and I remember, you know, going through that and. Yeah, and I asked the questions just so to hear him say it again, because it is interesting that. They're active managers and yet they're beating.
Yeah.
The passive guys.
On a net basis, so they gotta be.
Well, it's right, and that growth tilt is really meaningful.
And the home bias too.
The home bias, I didn't even realize that was happening, but yeah, so.
I wonder if they print the chart here and actually show standard deviations across this thing. To say what their target standard deviation is.
Yeah.
Across those different funds.
Yeah.
And target returns across those different funds.
Right,
We just didn't see that.
sorry, say that again.
If we could see that almost like the risk and return, you know, by the different categories.
Oh.
the vertical categories.
I mean, they're kind of showing you, this is the volatility at the top line here. So that's what you can expect, like in the accumulation.
No, that's the number of years retirement.
No, that's the volatility. So down 45, like you can expect to potentially see a down 45.
That's what that is there.
Yeah,
So that is the volatility.
yeah. So that's why like, versus like distribution, I think that's what that's talking about, right?
I thought that was gonna be years to retirement, right? And
Oh, you might be right. I'm
and I
sorry.
was thinking that it would be nice to see return
Yeah.
and volatility.
Yeah.
By each of the.
Well, I mean, think of it this way, like if you're 45 years out from retirement.
You can withstand a lot of volatility.
Yeah, and you're gonna have the highest standard deviation versus,
Definitely true.
so
I'm just curious what the numbers are, like what the range from here to here is.
it's 100% equity on the furthest out, so whatever that is in, Basic.
Like 18 or 17.
it's probably higher than that, right? Yeah, yeah. I think we've reached that pretty cleanly. Yeah,
All right.
yeah.
Okay, good.
Yeah.
Should we move on to performance?
Yeah, you want me to tackle it? All right.
Yeah, for the VC funds, yeah.
I won't belabor, market
I'm not gonna do
review.
every fund and every market.
I'll maybe, someday maybe that'll be interesting,
Yeah.
and we talked about this a little bit, and then we're kind of chimed in, but if we turn to page 26. Starting with the 401A plan. It's the big pie chart, so here we can see the allocation, and again, these are as of the end of the third quarter, so September 30th. So we see that 88% of the assets are in the target date funds. And then you can see the rest of the makeup. If you turn to page 28. The left-hand pie chart, again, is the asset allocation. The right hand is the contributions, like the most recent contributions coming in for that quarter. So this was sort of what I was getting at, is that more recently, dollars are being contributed to the broad equity offerings. Not surprising in this type of environment where they've done quite well. So people are saying, I'm gonna put a little bit, maybe I think I know something. Right? So I'm gonna put a little bit more into just straight equity as opposed to the diversification aspect of the target date fund. And we do see that, frankly, in various, VC plans, so
What's the time frame on this, on the contribution?
it's just for the quarter.
That's in the last
On the
quarter.
bottom chart,
You scroll up.
Oh, I've scrolled.
on the
Yeah.
bottom chart of the page, you can
That
see
chart.
year to
Yeah.
year.
I was scrolled up too far, yeah.
And, in some quarters, participants make changes. And this, I think these contributions also include, not just new dollars going into the plan, but also exchanges within
Right.
the plan.
Yeah.
But, for the most part, over the last 5 years, it's pretty steady.
Yeah.
We certainly have clients that look drastically different than this. And isn't necessarily good, it isn't necessarily bad, but, I think from the average participant perspective, the target date fund's a good solution.
Yeah, probably is.
It's even more interesting or pronounced on, if you go to slide 33, which is the 457. So here you see a lot of people going into the global equity broad, then you also see a really big increase in stable value. If you recall, at the beginning of the third quarter, we had that big sell-off. There was that whole like carry trade incident with the yen. And like all of the like Mag 7 sold off, and I'm almost curious if people kind of like reacted to that initially and went in and they're like, oh man, here we go, let me go to cash, kind of like type mentality. This is just,
And many of the participants in the 450 plan may also have a defined benefit plan benefit. So unlike the
Probably,
401A, those participants only have the 401A. That is their sole form of retirement. The 457 is a supplementary plan that is much older, and the participant base is much older. So it's typical to see.
A 40-year-old plus employee would probably be in both, right?
in both what? Oh,
Defined
yeah,
benefit
yeah.
and defined contribution, so they've got both.
Um, if we jump to slide 35, just real quickly, because they did touch upon this during their presentation, the two gentlemen just now, but taking a look at the performance of the target date funds. You know, it was a solid quarter overall. All of the vintages were up absolute basis. Mixed on a relative basis, the vintages near retirement outperformed their custom indices. Those further out slightly lagged. It's not surprising, again, based on what they shared. The ones near to retirement, they actually benefited from some of the yield curve positioning, as well as exposure to equity income equities, not to be redundant, but it was a choppy quarter. And so some of those dividend paying equities did well. Where those further out from retirement, they lagged in large part because they had higher allocation to the growth equities, which had that pretty big sell-off at the beginning of the quarter. So it's kind of to be expected. If we go out to the 1 year period, it's pretty much the exact opposite, because those growth equities, you know, over the course of 12 months ended 9/30 had soared, whereas a lot of those more equity oriented, or excuse me, income oriented equities were laggards to a large extent. So that's where you kind of start to understand what's happening when you look up these things. But
What's the second row in all these lines?
Percentile,
the target date, that's the index.
16 to 1.
Those are the custom indices.
Okay, they're custom indices.
Correct. Yeah. So think of it as the benchmark, if you
Okay.
will.
And the little numbers are the peer rankings.
Right. What I will say is
And your target date is.
the last row. That's
Yes.
our peer group.
That's
So that's the median target date fund
Yeah.
within our peer group, which is essentially all
It's the big five, basically.
available. No, it's all investable target date.
Okay.
funds. Yeah.
So the big five kind of dominate, right? They're probably,
Well, it's not
Maybe.
asset weighted, so,
okay.
you know, but I think what you'll see here is, one, we saw value outperform growth in the third quarter. So you can see the longer data vintages
Mhm.
underperform their median peer. I think it's largely driven by that growth bias.
Mhm.
But over time, it's done extremely well.
Mhm.
But
And these little numbers are the rankings,
yes,
Right.
exactly.
percentiles.
Percentile.
Yeah.
Okay.
But long year numbers look great, frankly. They have had a lot of value. If we turn to the page, take a look at the passive funds. Each of them really continues to track their benchmark pretty closely. The only one that's a little off here and there is the MSCI ACWI US Index Fund, the BlackRock. That a lot of that has to do with what's called fair value pricing. So there's these dynamics where you get adjustment of prices for non-US equities. In terms of their fair value, it occurs at the close of their local market, but before it's calculated on the US side. In theory, it's supposed to wash over the longer term, but you might see a little bit of drag or divergence in terms of that tracking error over shorter time periods. So we keep an eye on that, but it is to be expected, you know, on a quarterly or even like a 12-month basis, you might see some tracking error there. But no concerns with any of them. If we scroll down, you know, take a look at the equity managers, JP Morgan Equity Income, slightly underperformed for the quarter, but did finish in the top third of the peer group rankings. We don't have any concern there. MFS Large Cap Growth, really strong quarter. They were up about 250 basis points over the benchmark. A lot of this was driven by their GARPI approach, growth at a reasonable price. So reasonable valuations were rewarded. This is sort of like why they've underperformed over the longer term, frankly, because that hasn't been rewarded. So it's just what I talked about earlier with the target date funds. They finally got rewarded for being more valuation sensitive in the third quarter, but that's been a drag on their performance over the long term. GW&K, small mid cap, underperformed. A couple different reasons. Some of their exposures to financials and communication services, some stock selection within healthcare. But they, you know, if you look at the longer term 5-10 year, they remain pretty significantly above the benchmark and above median peers. So we're okay there. MFS International Diversification, really strong quarter, and they've added a lot of value again over the longer term. You know, in an area that has been a little bit weaker, the international side, they've done a good job. Some of their stock selection, they've actually been underweight names like ASML, the semiconductor, or Novo Nordisk, who does Ozempic and Wegovy, and they had a tough go of it earlier this year. And then TCW MetWest, I think Britt mentioned this earlier, but last year, the second half of the year in particular, they actually did pretty well. They've got the bet on duration, they're longer than the benchmark, and it has really hurt them in past years, but it's finally actually adding some value. TBD on whether it continues like that going forward, but we're happy to see them, you know, adding some value there. Last thing I'll note then is just stable value, positive return overall, but underperforming the benchmark. Again, we're seeing these dynamics where short, intermediate, and core assets have really been yielding less than money markets, because of that inversion in the yield curve. And that is to be expected, but somebody mentioned it earlier, we're finally hopefully out of that phase, and maybe now stable value. There is a lag effect, so keep that in mind, but if we continue to have a non-inverted yield curve, maybe it'll kind of right size itself.
They're underperforming the treasury bill for the past 5 years.
Yeah,
Well,
yeah,
you can
not
see
good.
all stable value. funds are.
Yeah.
right, all stable value. So.
You know, when rates go up 5% in 18 months, it's a dynamic that is inevitable, and, you know, stable value funds, one, have insurance wrappers.
Yeah.
And two, have a longer duration than 3-month T-bill. But we are seeing crediting rates increase, and we expect that to slowly catch up as rates come down.
Yep, then that's all I had. Any questions on that, or?
No, good.
The stable value, just out of curiosity, and I probably should know, but I don't. How does it compare to absolute return type funds, the stable value fund? How do they compare? Are they
I
apples and
wouldn't
oranges?
compare them.
Yes.
Yeah. There's a
Yeah.
lot going on in terms of like financial
It's really
instruments, and then
It's supposed to be a very safe, stable, fixed income like investment for participants to not lose money,
Okay,
right? I mean, that is ultimately plans either offer a money market fund or a stable value fund. Historically, stable value funds have offered a higher return over the long term, but given the rate environment that we've been in, we've seen money market funds outperform. But it's designed as a defensive fixed income strategy.
absolute return is I'd almost put it closer to like a hedge fund type of strategy.
yeah.
Where they're using a lot of derivatives, shorting, hedging, etc. So it's apples and oranges.
Okay, right.
Yeah,
Okay. The ultimate goal might be.
Similar,
yeah,
similar goals, just different strategies
yeah.
for achieving it. You know, obviously, in the case of UBS AIS, they've done a better job of actually delivering on that.
Yeah,
With a lot more potential risk though.
Yeah,
yes, correct.
All right, we go to the structure analysis.
Sure. So I think in the third tab of the book,
Yeah.
Rob, do you want to? So the investment structure analysis is really designed to look at the lineup offered to participants, confirm that it is reasonable, and see if there are any areas that we could potentially enhance. The last time we really took a deep look at this was during the record keeper transition, when the new lineup was rolled out for both plans. So we thought it was a good time to revisit it. I think ultimately, as you'll see on the second page, you know, the lineup as is perfectly good. I don't think there is anything missing. We do have some considerations. One is to add the 2 longer target date fund vintages to participants, the 2065 and 2070 fund. We will work with Empower to make sure that going forward, when they roll out new vintages, this doesn't fall through the cracks. Typically, you know, when the Capital Group announces the new vintages coming out, Empower will work to get the proper communications and roll out the fund So we'll work with them to add those if that's reasonable with the committee.
Makes sense.
And then we offer, you know, a potential option is, as you'll see, you know, the plans offer a value and growth style within US large cap, but offer core active strategies within SMID and non-US. If desired, and you wanted to add more choice, you could consider adding styles within SMID and international. I think largely we don't see a need for it, but if desired, it could be an option. Now that I've given you this punchline, just to kind of talk about DC plans in general on page 3, I mentioned inertia earlier. You'll see in the following slides, participants don't move their funds around as much as you might think. A lot of times, people don't look at their funds once they elect a contribution rate and are defaulted into a target date fund. And, you know, despite wanting to offer a very robust lineup, largely these funds are not necessarily used correctly. Participants chase momentum, they chase news headlines, and it's not always the best thing for their future retirement. And lastly, choice. I think, you know, before the record keeper transition, there were hundreds of options in these plans. And it's quite frankly, it's overwhelming.
Yeah.
Keeping it simple, offering the basic asset classes for participants to build a diversified portfolio is ultimately the goal. And you can see that on the next page. We think of a DC plan in 3 tiers. One is in the target date funds, offering a diversified multi-asset approach for participants. This is kind of do it for me. Tier 2 is I want to build my own diversified portfolio. So, you know, what are the main asset classes that we believe a participant needs in order to do that? Capital preservation, fixed income, US equity, non-US equity, and SMID cap equity. The specialty tier, we do not advocate for. We think this often leads to participant chasing returns and potentially adverse outcomes. We do have clients that have a brokerage window where participants can go and either buy mutual funds that are not offered in the plan. Ultimately, Norwalk has not elected to go down this route. There are lots of fees, and you can imagine how many securities and mutual funds are available when participants go down these avenues. But tier 2 and tier 1 really make up the building blocks that we believe are reasonable for a participant to build a diversified portfolio for their retirement. On the next page, we lay out Norwalk's 401(a) plan lineup, which is the same for the 457 in that tiered structure. And you can see you offer the target date funds, a passive sleeve, which is great if participants want low cost access to these asset classes, they have it. And then we offer the active side on the right there.
Those percentages or what are
Those are the percentage of participant assets.
assets? Okay.
Yep. And on the next slide is the 457.
There were only 3%, about the, we're at 90% active. And that's it.
Mhm.
Yeah.
And largely in the target date.
Yeah, right.
And the default for new money and new employees is the target date funds.
Correct. Yep.
That makes
based-
sense too.
Based on their date of birth. Yep.
Do you know offhand how much our assets there have gone up in the past year? We've gone
For
to,
the 401(a).
yeah, we've gone to from 0 to 22.5 in 5 years, right?
You know, I think 10 years ago, I probably started working with Norwalk and we were just reporting on the 401(a). I think it was $1 million. So it's grown.
It's been 10 years since we've been in this?
Yeah, the plan closed in 2012.
Okay.
Yeah, I was gonna say it's probably
Oh,
more,
okay, wow.
but it was very small.
I'm sorry. more
So
recent
it's growing for sure.
than- Oh, that's right. I guess it was before I got on the board. Okay.
Maybe I'll jump to page 9. Just to show you, you know, you offer this sleeve of passive strategies, sleeve of active strategies, which largely is in line with with what all of our clients are doing. You can see the chart, the green and the blue. You know, an active passive mirror means for every active asset class, you offer a passive option, which Norwalk does. You know, some choose to not offer active large cap equity because active management has really struggled in that area and they only offer a passive option.
Not much alpha anyway.
You know, it's really a opinion of a plan sponsor, but you know, over 90% of plans are offering this mix of active and passive option to participants, and that's really the standard today. On the next slide, just in terms of, you know, the number of options being offered, Norwalk slightly below the average from our DC index, which is over 100 large institutional 401k plans, or excuse me, DC plans, but largely right in line with the industry average. And I might just touch on slide 13.
Can you go to 11 first?
Sure.
What do we think about a money market fund?
So we've had a lot of clients, you know, we've talked about stable value. Given the rise in interest rates, money market funds have certainly outperformed. Might be good to provide some education on stable value versus money market. You know, historically, stable value in the long term has provided a better return.
Okay.
In the short term, given the rise in interest rates, money market funds have done extremely well. You know,
Do we think we're on the cusp of that turning?
we do.
Yeah.
I mean, I think we wouldn't recommend offering both a stable value fund and a money market fund. You know, of the clients, most clients that have a stable value fund right now are asking the same question and going through the same exercise of,
Yeah.
you know, are stable value funds really the right capital preservation fund to offer?
Yeah.
I have not had any clients change ultimately, but
Yeah.
we have some material, it might be helpful. The details, you know.
It'd probably good, just look at his long-term history on it, you
Yeah.
know, just not make a big deal of it, but just refresh everyone's memory because it does look wacky right now.
It does.
Okay. You want to go, what, 13?
Yeah, maybe let's go to 13, just in terms of demographics. So here, you know, 401A, you can see there's a large portion of people under 40 years old in this plan. And I think importantly on the right, you can see the number of options within each age band. And I would say it's probably as good as any average number of options I've seen within a plan. You know, oftentimes you'll see 4, 5, 6, and they hold multiple target date fund vintages and aren't using the investment options correctly. And so I think that's a very positive aspect of the 401k.
Is that a reflection of Empower's training and presentation, or just our employees are?
It could be that, it could be inertia in terms of being defaulted into a target date fund and not electing to.
That's not a normal practice, defaulting?
No, it is.
Yeah.
And we did that in the last 5 years, right? It's when the default became the target dates.
Yes, when we
Sign of
rolled out the
Empower.
new lineup.
Yeah.
And essentially we had, you know, call it 100 investment options, and we couldn't really map the assets to
Yeah.
the new plan. So they were mapped to the target date funds, but participants, if they elected to, could move their funds elsewhere. And then the next page, you can see the 457 plan. I know we talked about it a little bit earlier, but a much older population, you know, largely over 40 years old. And they tend to be more do it for me, use the active core options than the 401A plan. And you can see that play out on 15. In terms of, you know, what are these participants doing by age group? The majority are in the target date funds. You can see the older participants tend to utilize the core investment lineup more versus the younger participants.
Is this participant universe growing flat? What? 450, sounds like an old number we've seen in a long time, is that? Is this closed or is this still open?
They're open.
It's growing, buying them up too,
I
probably.
believe all new employees are going to the four.
Oh, okay,
Yeah, automatically they go to.
the 457 is
And
closed.
no,
No,
you
it's
could,
not closed.
yeah, no, it's not closed.
Okay,
They could elect to go also to the
Okay.
four
Yeah, it's a
fifty-seven.
voluntary
Mhm.
plan.
okay,
And you can see a bit of a change on the 16 in terms of how these participants are utilizing the menu. And you can see, I think it's being skewed a little bit on the younger because there's so few participants being counted for here, but the managed accounts that we talked about earlier, where you engage Empower to pay for investment advice and how to invest your assets. Just a couple more slides on 17, I think. You can see in the top left. You know, the number of target date fund participants that are holding one target date fund is 98%. That is exceptional in terms of utilizing the plan lineup correctly. And similarly on the next page, you know, participants using target date funds, 95% are using one vintage. So that's encouraging from a standpoint of participants are not investing for the most part in multiple target date fund vintages, and you know, they are efficiently investing their assets based on their age, which is great.
I understand. Chart 16. Supposedly 50%. Participants are in a managed account, right?
I think it's because there's so
Under 25.
Under 25. Oh, this isn't by age and 40.
I think it's because there's so few participants. I think it might be 2 participants. And one of them is probably using, or 3 participants, one of them's using.
Because normally you would see
It's
the
being
reverse.
skewed, it's being skewed.
Yeah.
220 something.
You would think normally like where you see managed accounts being used is by the older.
Right.
Yeah.
Yeah, I think just because of the population demographics, it's being.
I mean, the same for the 25 to 29 group, yeah, that seems high.
Yes.
So it's
They all
probably-
seem high.
It's probably 4, yeah.
We like if over a bigger plan, you rarely see anybody under like 50 using managed accounts.
Right.
And on page 14, you can see. 6% of participants are under 30 and they make up 1.2% of the assets. So. Yeah, maybe it's 10, 20 people.
Yeah, okay,
It's very small.
Yep.
And then I'll jump to 25, just so you can see what, you know, the considerations look like. I think from a Callan perspective, adding the 2065 and 2070 vintages is prudent to give new younger participants access to their appropriate target date fund vintage. You know, while you could add style options within non-US and US mid cap, we really don't think it's necessary. And if anything, it will add complexity to the lineup, and you know, the funds are doing well. We don't see any reason to add.
If you drop the MFS and the GWK funds, where would they go into the?
They would probably map to the target date funds. Just because you
You got
could,
just a notification that we're doing this and this is where you're going, if you want to do something. different.
yeah, there's participant communications involved, and participants would need to, they would get a window where they'd be able to change.
And there's only like. 90, 80,000 in those.
Those two accounts, those two
Yeah.
funds.
Very small.
Yeah.
So, I mean, largely
And
from our
it's in an older age group, right? None of the
Probably.
younger.
yeah, I think that's correct. 457 largely are using the core options versus the 418.
Okay.
Yeah, I wouldn't think we need to add any more complexity.
No,
Those go from. What are we now, 12, how many options do we have now?
11 if you count
11,
the target
so
date
I think
funds
it's
as well.
been 9, right?
Are we talking about dropping or just not adding?
No, we wouldn't drop them. We'd only suggest dropping them if you wanted to add the additional ones.
So we'd stay at 11.
Oh, so we're not dropping the MFS and GWK.
No,
Okay.
it was a consideration, just to give the board something to look at because we think the plan's in good shape.
Make us think we have
Yeah.
You know, one
a
of
decision to make.
our,
Well,
I
do
think,
we know, how many participants are in the two funds? Can't be very many. Very, 90,000 between the two of them.
well, that's in the one plan. Yeah, or are you looking at both?
No, I'm looking at both. GWK's got 17,000 and MFS has got 75.
Yeah. I mean, I think from a core building block perspective, we would certainly leave them in the lineup. We
Mhm.
think from a lineup perspective, it's a very streamlined, well-performing lineup, and we see no need to
Yeah,
change.
okay.
Yeah, it seems like our philosophy is that we want them really to use target date fund. And we're trying to tilt that way. We give them the option to assemble their own thing, but simple options, you know, to do that. And then I guess there is some additional options on top of that are out there. That third column there, right?
Yeah,
Active core options.
if you want to go active versus passive, they have the
They have the
option.
option to do that.
Yep.
And if we're gonna, then we have to give them the options to build what we would say is a complete diversified portfolio.
And they have enough here to do
Whether
that.
they utilize them or not, that's their decision, but from, as you guys, it's the fiduciaries.
That's what,
Yeah.
so we give them that option.
Right.
So, you know, given all that, I mean, this feels like we're doing the right thing.
Yeah.
With TDF being really the main,
Yeah, I think ultimately, every plan's goal is to have a larger and larger allocation to target date funds for their participants.
and as long as our TDF supplier is one of the top tiers,
Right, I think that's why, you know, one of the reasons we've had them in annually is because they make up such a large piece of the participant asset base.
that's our risk. If they fail to perform, then obviously.
I'm not sure we need it, but just for administrative completeness, we have a motion to include the American funds target date 2065 and 2070 funds in our lineup.
Sure,
So moved.
I'll second that.
Okay.
So it's by default,
All in favor?
we do
All
that.
right. All right. Good. Anything else, guys?
Yes.
Very good. One more motion to adjourn.
Motion to adjourn.
You have a second?
I'll second this.
Okay.
Second that.
All those in favor?
Aye.
Meeting adjourned. Thank you all.
Thank you.
Thanks, everyone.